Now, next up, our second session for today, let me introduce our speaker. He is Alex Hill. Alex is the first chairman of Malaysia chapter of CMT Association. He has extensive experience in the fund management. So formerly, he served as a fund manager in VCB Capital, a boutique asset management company for more than 5 years. And currently, Alex is the fund director of SC licensed robo-advisory firm, the BH Global FinTech Solutions. He specializes in trading systems and strategies, value investing, trading psychology, as well as developing and programming of machine learning algorithm for robo-advisor. So without further ado, let me pass the presentation to Alex.
Right. Okay, today is the last session that I will have in my career. Public talk, my last public talk. I've actually retired as a fund manager and as well as a fund director, and I'm currently just playing golf every day. You can see from the background there is a lot of golf sets. So I've not seen my laptop for 3 months, just playing golf around Malaysia every day. So today is the last talk, so I just want to make it count, and I want to share with you the gist of trading. The essence of it, because I'm grateful truly that the financial market has been around for over 100 years. My grandparents have made their money from it, have made their millions. My uncles have made their millions. I make my millions from this financial market, and it does not have to be insider trading. It can be technical trading, and you can win. So may the skillful wins in this financial market game. I think it's a very challenging and very fruitful game. If you put your heart to it, you have to really focus and put your heart to it. So it is not an easy game to win, just to be clear on that. Today's topic really is about technical analysis, and a lot of people question, do these things work on FCPO and FKLI? Because we are talking about in relevance to our Malaysian futures, and there are only two, which make things a lot easier. Because I also trade the US CME products, which is the Nasdaq E-mini, the S&P E-mini, the Gold E-mini, and you will have the FX futures and all those things. So those are a lot more complicated. So when it comes to Malaysia, we are blessed with simplicity, just FCPO and FKLI. The answer is yes, you can actually make money for both of these products. They are not easy. There is a little bit lack of liquidity. Especially KLI is compared to FCPO. FCPO will be more liquid, but there are opportunities out there. And can you actually make money with technical trading using technical indicators? Either you use some people's indicator or you self-invent some. The answer is yes as well. Okay. So I'm just going to share from my own experience how does indicator works and why is it just a part of the sum of the whole game, because it is not only technical indicators that you have to look at. You have to look at other dimensions as well. And you can't just be relying on technical indicators, right? Like MACD crossover, moving average crossover. It can't be just one indicator. So it doesn't work that way. I mean, at least that's my experience over 20 years of trading. So I'm just going to share with you this one indicator, harmonic pattern, and it is actually doesn't really matter if you don't use it. Maybe it's just a good idea for you. You don't really have to use harmonic, and harmonic itself is also just an evolution of Fibonacci. Yeah, as you all know, Fibonacci is an interesting numbers that seems to work in the financial market. It seems to be self-fulfilling. So I want to make it clear that it is part of a multi-dimensional strategy, because multi-dimensional works. A single indicator doesn't work that well. I wouldn't say it doesn't work, but probably you'll be earning like small money with it. Okay. So I want to introduce to you not just harmonic, but the concept of multi-dimensional angle into trading, into technical trading. So I'm just specifically talk about technical trading, and I'm talking about different angles to it. For example, if you just want to have a more overall pictures, you can talk about fundamental analysis, technical analysis, okay, which is CMT. Fundamental is CFA, that's where you can study. quantitative analysis, which is CQG, and also sentimental analysis, which is the use of machine learning for news and stuff like that, and sentimental social media, big data analysis. So there are 4 dimensions in the overall picture. So technical analysis is just one of the 4. Of course, as a fund manager, you have to master all 4. But if you are just a retail investor, probably you start with 1 or 2 and continue to study the rest for the rest of your trading career or trading hobby. Okay. And within technical analysis itself, there are also multiple aspects of it. So if you just look at momentum, for example, so what are the momentum's indicators? Maybe you are talking about those momentum measurements like Ichimoku, like yeah, too long I haven't been using technical analysis. There are many of them, and also those like for example that looks like the car meter, okay, speedometer, velocity measurement. Those are the momentum indicators. All right, you can look at. You can also look at trend indicators. That is a different dimension. You can look at volatility indicators, which is like Bollinger Bands, ATR, ARIMA, GUTCH. That's another dimension. And you can also look at news dimension, which is economic data release and federal policy, as well as Malaysian government policy. So various dimensions combined together will let you look at the product that you want to trade, like FCPO or FKLI, in a different angle, so that you can have the more complete 3D picture of this product that you want to trade. So if you're just looking at one single indicator and you hope to make money from it, it is not to say impossible if you really master it, but it is not that easy, because trading is really more than just technical. It is because from a person who is totally from technical background, that I used to not believe in fundamental at all. I just believe technical will do, and I try to prove it. And in the end, I just proved myself wrong that actually technical need to be combined with fundamental. Yeah, like for example, FCPO, we are talking about seasonality. FCPO has its fundamental. FKLI has its fundamental both from Malaysian economy as well as from the US as well, that it is affected by the NASDAQ and the Dow Jones. So there are fundamentals in it, and all these are because of government policies, geopolitical events, pandemics, COVID, and stuff like that. So there is fundamental behind. So you can't just be looking at pure technical, and just say that, oh, I want to make money with technical. I want to make money with harmonic pattern. To me, it does not work that way. Of course, there'll be people who disagree with it, but from a pure technical person like me to say that, then probably you should take it and think about it, that you can't just be relying on pure technical. I proved myself wrong over the years of 20 years of my career. Okay? I want to prove to everyone that technical will do. In the end, I'm wrong. Okay, so I just want to share with you that. So I will share with you a strategy specifically that can be used for FCPO, FKLI, but I just want to apologize because certain of these slides were prepared while I was still having my laptop, but because my company laptop, I already returned to the company, BH, and I don't have the data anymore for FCPO and FKLI. I'm not trading them anymore. So that's why I don't have examples on FKLI and FCPO, but I have a lot of other products, example from CME products. So I just want to apologize for that. Yeah, there is lack of local examples for this case. Normally, all my other talks previously have a lot of local examples, but probably not today because I don't have a laptop with the company laptop. This is my personal laptop, and I lack data. So I always need data to justify what I say. But I still want to give you a conceptual understanding that on a multi-dimensional strategy, specifically just one strategy. All right, this is not many strategies, just one strategy. By using 4 dimensions to look at one product and trade one product. Okay, so that's what I want to share today. And you can apply that to any product, and you can apply to any different indicators, but the dimensions should be multi and not singular. So that's something that you can take home with. Okay, like for example, I'm talking about harmonic today, but at the same time, I'm talking about another dimension, which is volume. Harmonic is about price pattern. Okay, price pattern. So price pattern, if you don't use harmonic, you can use chart patterns. Okay, you can use Fibonacci. Okay, you can use things like basically related to price pattern. Okay, so that's harmonic. What does harmonic does is that it analyzes price pattern and it tells you the odds in favor of downtrend or the odds in favor of uptrend based on price pattern, based on chart patterns. So that's one angle or one dimensions to it. Another dimension that is always volume, especially if you trade stocks, if you trade FKI, you always need to look at the volume. So volume indicator, it can be on balance volume, it can be VSA, volume spread analysis, it can be any other type of volume indicator, okay? But it has to be a different dimension from price. Because if you use a harmonic pattern, and then you use chart patterns, and then you use another indicator that's related to price, it's just using back the same dimension. It doesn't add value if you use too many of the same dimension. Example, if you were to use MACD together with stochastics, together with RSI, together with William R, they are more or less of the same nature. They are all oscillators. You're just using 4 oscillators, 4 different oscillators, but looking at the same angle to look at the same product. It doesn't add much value. So what you can take home with today is, if you want to use multiple indicator, and of course, certain people like some doctors in trading, I don't know, come into my trading room. What is the author again? That guy, yeah, and a few others, people who really know about trading, and they are the trading guru out there, recognized by Wall Street. They always say the most efficient is up to probably 5 indicator. More than that is too much. Less than 3 is not enough. So it's between 3 to 5 technical indicators, different dimensions. Not to say just the technical indicators like RSI and MACD and stochastic is not considered one indicator. It's just 3 indicators. It's just one indicator. So volume analysis is one indicator. Harmonic pattern is one indicator. And then you have volatility maybe as another indicator. And then you have news as another indicator. So you have 4 indicators, 4 dimensions of looking at things. And I'm just going to give you a specific case study today. That volume, we are using VSA. Price, we are using harmonic pattern. Volatility, we are using Bollinger Bands. And news, we are using economic data release. So this is a specific case of 4 different dimensions and 4 indicators to address this dimension, to look at one product, and that is one strategy. This is not 4 strategies, it's one strategy. And that's how complicated, at least it's the most basic complication that you need to have to win in the stock market or in the futures market. One indicator itself you can't win, according to my own experience. So first of all, I want to talk about volume analysis. So it always starts with volume. And of course, it evolved to fund flow analysis. Like it's not stated here, but you can evaluate the volume of the product that you're trading. Like FKLI, you can break it down to different component stocks. The top 10 component stock of FKLI, like Maybank, Public Bank, Tenaga, Genting, all those. And then from there, you can break down their volumes, each component stock's volume, according to this volume come from the institution? Does this volume come from the retail, or this volume come from the syndicate? Who contributed to this volume? So we are talking about fund flow analysis as an alternative replacement of volume analysis, as an alternative replacement of study of volume itself. But it is one dimension, which is volume analysis. All right. So there are other talks that I talked about in the past that talk about fund flow analysis. Because if you are talking about stock market or FKLI, which is the index of the stocks, you need to analyze where does the volume come from? How many percent of it today is from the institution? How many percent is from the retail? As we know, institutions move the market, the retail does not move the market. Stock market is man-made. It is manipulated to a certain extent, but there is free market, freedom of choice, or the free mechanism out there. It's not 100% manipulated. It is still subject to market forces. So there are still chances to make money even though you're not insider. right? That's what I'm trying to say. And that is one dimension. So volume is one dimension, and this one indicator that I want to share with you is called VSA. These indicators, of course, is all free out there. You can just Google it. You can get free indicator. All right, whatever I share here, you can get online free. Right? You don't even have to get it from me. Right? VSA is a very popular free indicator, and how to use it is very simple, right? Overbought and oversold by volume. If there's too much volume, you will see that, and it's overbought, you'll see a red color bar in VSA. And if it's oversold, you will see a white color bar when the price is oversold. FKY, FCPO, right? You will see a white color bar. So this is the most simple way of understanding VSA. There are other colors as well, which I don't want to talk about. So I just want to leave you with white and red. So red is overbought, white is oversold. Simple as that. Okay, VSA. So VSA, it was quite a long time ago. Richard Wyckoff, 1920. Yeah, supply and demand. And he wrote a book on it, so it became popular. So and that's based on tick volume. Okay, so I want you to take home today that you need one volume indicator, no matter what products you trade, except spot forex. Spot forex, there is no volume, there is no standardized volume. So that's the reason why I don't trade forex. It's a very, very difficult to win product, to be honest. And you can't have volume, then I lose my advantage because I analyze volume a lot. Because volume is the telltale sign of what is going to happen. All right. So if you don't have volume, then it's very hard to trade. But in futures, you have volume, right? And it's a centralized volume. Bursa Derivative Exchange has the volume data. You can have level 2 volume to analyze if you buy. And CME, of course, you can have level 2, level 3 volume if you buy. So volume is really the key. That's why I start with volume. I don't start with harmonic. Harmonic is the price. Volume first, price later. Okay, because price is the result. Volume is the reason, is the cause. Price is the effect. So I want to talk about volume first. Okay, so when there is a lot of bid and ask of volume, we want to look at depth imbalance. Depth imbalance means the volume is skewed towards one area. Like for example, it's not just done volume or volume that is traded, but queuing volume, ask volume, and the bid volume. So if you have the ask volume, is a lot of people want to sell, and the bid volume is very, very thin, then we are talking about that imbalance in one side, skews toward one side, that there are a lot of sellers, very few buyers. Example of that will be MYEG. Right after the opposition won the election, the next day, MYEG has 0 buyer and millions of sellers because it's kind of like political related. You all know what I mean. And that is called depth imbalance. So depth imbalance, undone volume, means volume they are not traded yet, but their Q volume will actually affect price because it will affect the seller to want to sell lower and lower and lower in order to get it done, because out of fear that they cannot get it out of their hand, that this stock is now worthless, it's going to go low. So if everyone think of that, then the price will be affected by volume. So you can see when market opened on Monday after the opposition won, that time during the election, it opened at 280, and then it straight away go to 270, 260, 250, 240, 230. And only at 180, there are some buyers, and I immediately get out because I was holding some of those stocks, and it remained with me for life. I'm scarred for life because of that MYEG, right? So volume affects price. So you have to know volume in futures trading and in stock trading. Okay, you have to look at volume. It's impossible that I think you can win without volume. Yeah, analysis. Yeah, or even you win is not that easy if you can. So I'm just going to give you an example on VSA, which is a free indicator. You can get it outside, right? You can just Google VSA free download. Whatever. I'm not selling any indicator, by the way. I'm definitely not selling you anything. I'm just sharing with you that I used to use this indicator, during my younger days. And you can see that when VSA has red, it's almost oversold, and it's overbought, and you can see that price might reverse down. Okay, right. right? Even though these examples are not related to futures, not exactly KLCI, but these are FX futures, they are still futures. So it is kind of like related, okay? So you can see from here that whenever there is a red volume, it could mean an overbought. So try to simplify technical trading. If you have too many confusing indicators, you will get lost. You have paralysis analysis, you can't make a decision. But you must have a very clear-cut idea like what triggers a signal. Is there a signal or is there no signal? It has to be very clear-cut. So whenever there's a red, it is a potential of a signal. It is not a signal because you need to depend on other dimensions, agree with this. If other dimensions don't agree, then you don't have a valid signal. If other dimensions agree, you have a valid signal. But this component of the overall give you a signal. It means that it is a sign of selling instead of buying whenever the VSA turn red. Then you need to look at other dimension. But this is important, right? So the same thing when the price are going down, when you see white color, this component or this dimension give you a signal that it is a chance of reversal to the upside because it is oversold now. All right, but you need to look at other dimensions to confirm this itself, it is not enough. Okay, just the volume itself is not enough. So you can see when the breakout just started, it just continued to go down even though you see whites because these are the false signals. So these are the noise. But when it go down for extended period of time, then you can see that it stops and then you reverse. So you can't just say that, oh, because one of two signals are noise, this is not reliable. Technical signals are never 100% reliable. You are good enough if you have a 70% reliable signal. Normally, it's only about 55 to 60% reliable because out of every 100 signals, only about 60 signals are valid. The other 40 signals are noise or they are basically false signals. So be very careful when you are discouraged by just one or two false signals, or you are discouraged by one or two losing trades. That's what discourages 90% of retail traders quit the financial market because they were discouraged by one or two trades, which doesn't make sense to me because it's a probability game. I know when I trade, it's like going to the casino to bet that if I have a strategy to win, every 100 bet, probably only 52 are going to win in a roulette game because I have a way to win. But it is not a very high odds, it's very low odds. And I have to get everything right, then I can win. So I have to be ready that 40x of my trades are going to lose. And every time I lose a trade, I cannot feel bad. I have to tell myself this is just one of those expected losing trade. Good trades will come sooner or later, and I'm going to have more winning trades than losing trade. And I have to have 100 trades before I can see that this strategy works because it has about 60 winning trades and 40 losing trades. If you just have 10 trades, it is not good enough. You can have 6 losing trade and 4 winning trade. And you tell yourself that, well, this strategy is not good enough, but that is not, that it doesn't make sense because it's only 10 trades. 10 trades statistically is not significant. 100 trades at least statistically is slightly more significant. The best you can have is 300 to 500 trades. Then it is statistically significant. You can prove to yourself that this strategy will or this strategy doesn't work. But the problem is you don't have time to prove this and prove that and do trial and error because you're not full-time trading. People like us who are full-time trading, full-time testing system, we have the time to prove this and prove that. Everything needs to be proven. It is a science. Trading can be a science. It cannot, it does not need to be just an art. It can be a science and you need to prove everything. And so you need time to prove, all right? So that is volume as one dimension. And the example I give is VSA, but it can be as good as other types of volume. Like for example, like some of those volume indicators, they analyze the Malaysian stock market, like Sky Pontoon, the dragon, the multicolor dragon, those things that some of the China software use to analyze Malaysian fund flow, those are volume as well. So just choose one indicator for one dimension. So here I choose VSA. The second dimension is volatility. So volatility, there are ATR, there is Bollinger Band, there is gauge model, different types of gauge. There are B gauge, G gauge, F gauge, okay, and E gauge. And there are also Arch model. There are also Arima model, Sarima model, especially for FCPO with seasonality. Sarima model will make a lot of sense. And there is also VAR model, vector auto regression model, which is a volatility model as well, and there are VECM models. So we are talking about one volatility indicator as a separate dimension from volume. So here I just choose a simple example of Bollinger Bands. It is a volatility indicator, and it is by John Bollinger, and he used this indicator to earn a living, feed his family, and his son is also in the Malaysian, the Chartered Market Technician Association, the CMT. You know, we are all in the CMT, so I know that Gerard Apple's son is also in the CMT. Martin Cream's son is also in the CMT. They use technical indicators to make money and feed their family. So this is something serious. We are not talking about just for the fun of it. They actually need this to make money in order to feed families. So John Bollinger uses this extensively to make money for himself so that he can feed his family. And this is a volatility indicator invented by him, and it's based on a very simple concept of central limit theorem, the bell curve, right? It's so simple. It is so simple, but people thought of it. People might think of it, but didn't pen it down. So he was the one who penned it down and tell people a simple secondary school central limit theorem can be used for trading. And 68% of the time, the market is just moving within one standard deviation, including FKI, FCPO. And it's proving to be so. It's proving to be so. As long as there's not big crisis, this central limit theorem applied to FCPO and FKI are quite accurate. It is so, right? So most of the time, it's just fluctuating between one standard deviation. Sometimes it's 2, at most it's 3. Only market crisis like 2008, you can see 6 of standard deviation, but normally that doesn't happen. That is not this. So that's why John Bollinger makes this very, very easy to understand. Like +3 standard deviation will be good for support resistance, something like this, right? And then -3 standard deviation of good support, +3 is good deviation for resistance. So we can see from here that when price goes to below 3 standard deviation, it rebounds up, and price go to upper 3 standard deviation, it goes back. So this is based on volatility, which is a different dimension from VSA, from volume, and which is a different dimension from price, from harmonic. Okay, so before I teach harmonic, I want to lay up the foundation leads to price, which is the end result, which is the last thing to look at is price. It's not the first thing to look at, it's the last thing to look at. The first thing to look at is the volume. The second thing to look at is the volatility of price, okay, which is the Bollinger Bands, okay? So you can see from here that when you have a red VSA bar telling you that prices are overbought, and then it reaches the top of a Bollinger Band +3 standard deviation, it tells you that prices are overbought. So 2 different dimensions telling you the same thing. You have to take advice. You know, that for example here, VSA rate shows you that it's overbought, but it's just at the middle of Bollinger Band. It doesn't make sense. So we have to wait until we reach the top. So when you have 2 confluence or convergence of signal, that both of them agree with each other and they are from different dimension, and there are 2 different indicators agree from each other. One is a volatility indicator, the other is a volume indicator, and they agree, you should take heed that this is important. Right, this is something important. All right. So another example here as well, you can see that it is oversold because it's white, and it's oversold because volatility reaches what, -4 standard deviation in Bollinger Band. So when 2 different dimensions agree with each other and both give you the signal that it's time to buy, volume indicator tells you it's time to buy, a volatility indicator tells you it's time to buy, you should take heed. You should pay attention that, okay, I should take a look. All right. So finally, after I've laid the foundation for price, for harmonic, now you are ready to take into price pattern. Okay. So there are many names to harmonic. You have bats, you have crab, you have Gartley, you have cipher. It's just different types of harmonic, and the indicators of harmonic can automatically trace all this for you. You don't have to remember them. You don't have to hand draw them. In the past, we have to. Now you don't have to. There are many free indicators out there in harmonic that you can just download and use. So the essence of it Okay, I just want to tell the essence of harmonic. The essence of harmonic is that it is double Fibonacci retracement, double retracement. You can see from here, that is one retracement and there is two retracement. And this retracement follow a certain ratio, then the chances of going in the opposite direction is really, really high. This is a lot of mathematics behind. There's a lot of financial ratios behind. There's a lot of golden ratios behind, and it involved in Fibonacci is all around us, right? In our human ratio, in our nature, and also in the financial market. It's just amazing why it is that way. But harmonic is based its foundation on Fibonacci, and it's double Fibonacci retracement. Okay, just to be safe, right? So you can see from here that there is one Fibonacci retracement, there is a second Fibonacci retracement, and it's in a certain specific order. And this is the indicator I got from online for free. Yeah, and that you will just that the pattern came out that it tells you that this is a bad pattern, and this is the timing to short the market. That this is X A B C D. Okay, then it's time to short the market. Okay, so this point is the point to short. So price pattern based on retracement has a certain danger because it's counter trend. Just like Fibonacci has certain danger, it is counter trend. So how do you know that this retracement is good and it's going to go the opposite direction, like it's going to go down? And the other retracement, that it goes up to the Fibonacci ratio and this is going to continue going up and you're going to lose money. How do you know that? The answer is very simple. That is fundamental. You have to know the fundamental. That are we in the bear market? Are we in the bull market? If you're in a bull market, then nothing holds. The price is just going to go crazy and just going up. If you're in a bear market, then yes, then probably when this pattern appears, price is going to go down. So the fundamental behind the price movement is very important. You can't just be looking at technical without taking a look at the fundamental. And of course, you need other dimensions to confirm as well, right? So let's look at other dimensions to confirm. So you can see from here that the VSA has a red telling you that it's overbought, and price has reached a Bollinger Band 3 standard deviation telling you the price is overbought. And then you have a harmonic back short pattern telling you that price is overbought. So you have three dimensions: a price dimension, a volume dimension, and a volatility dimension telling you that price is overbought. You should pay attention because they are from different dimensions. They are from different angle looking at one thing, but telling you the same signal. Then you should pay attention. And true enough, you can see that price go down. And of course, you can program the whole thing automated. All right. To trade FCPO, FKRI can be fully automated. You don't have to look at the market. Just let the system trade. Once you have the strategy stabilized and put it into object-oriented programming modules, just let the system trade, and you can change the module every time there is a new indicator. Just update the modules. So if you program your system in an object-oriented way, it's easily changeable and updatable and upgradable. If you put it in a structured programming, it is very hard to upgrade. You need to change the whole system coding. So for those of you who are playing around with automating your trading, you will know what I'm talking about, okay? Because we automate our trading. We don't look at the market every day. It's a waste of time. Might as well go and play golf. Let the system take care, right? So the next pattern is Gartley. The ratios are different, but overall it does the same thing. Like this is a Gartley pattern, X, A, B, C, D, and that is the price to long. And before you long, look at the fundamental, look at the volume, look at also the volatility. So let's combine this. You can see VSA is what? White, means that it's oversold. All right, and then it reaches what? Bollinger Band -3 is oversold. And then harmonic Gartley pattern telling you that it's oversold. So three different dimensions telling you it's oversold. You should pay attention that it might be oversold and price could be going up. All right. So sometimes news, bad news come out here. So what does this mean? That once the bad news come out, straight away price shoot up, especially for CME products. And people wonder, isn't that bad news? Why does price shoot up? Isn't it good news? Why does price come down? Because price has come down before the news is released. This is insider trading. They know the news 1 hour before you or 1 day before you. And the only thing that you can be on par with insider is technical analysis, multi-dimensional. Okay, so even though you see that the price, the news releases, oh, this is the bad news, but Bollinger Band telling you price is going up, VSA tell you price is going up, and Harmonic tells you price is going up, you better pay attention that you should not be shorting even though the news release is bad. And that is where we have the herd mentality fear, is that all your friends are shorting and you know the news is bad. And then in the news, all these market gurus tell you to short, the financial is bad. But all the technicals suggest otherwise. That is where you need to be firm and believe in yourself and believe in your indicators other than the herd mentality. That's one reason why a lot of people could not make it in trading, is because of herd mentality. All your friends are doing what the market tells them to do. And if you do the opposite, well, if you lose, people are going to laugh at you. And if you win, people are going to hate you. That is the reality of trading. If you win, just look at Jesse Livermore. Just read his book and listen to what he says. If you are a winner of the market, your friends and people around you are going to hate you because they are jealous. They can't win, but you can. You are going to have no friends, even if you win in the financial market. And if you lose in the financial market, well, people are still be your friend because everyone comfort each other, everybody lose, and some of them might even laugh at you. Oh, you're not smart enough. So financial market is such a cruel and mean game that you have to be mentally very strong in order to play this game for the long run. All right. Just this is my warning to you. Like some of you are here. This is your era. Like my era is over, but this is the era. Oh, I want to be a good trader. I want to learn trading. I want to trade and win in the financial market. Yes. 10 years, 20 years later, you will realize what I said. Yeah. Nobody is going to clap. Yay, well done. You have made money. Nobody's going to do that for you. Right? You will have nobody cheering you when you win. Right? Your reward is the money. And that's all. And if you lose, well, probably you lose your money and you get some comfort from your friends. That is the reality of trading. That's what makes trading so difficult, because it's anti-human. Right? Trading is anti-human climax. And if you can really take it, then you are strong enough, then you can really make a living out of trading, which is a very tough thing, which is like 5%. Even in Malaysia, I look around, professionals and retail traders that I know over the last 20 over years, 5% can make it, 95% lose money and treat it just as a hobby, as a topic. Right? Some of them are already millionaires, right? And some people just can't afford to win, can't afford to trade. I have friends who tell me, Alex, just help me to make back that 100,000 that I lose, and I'm going to stop trading. Just help me to make back that 100,000. So I have to tell my friend, can you afford to lose another 100,000? Because if you want to risk your money to make that 100,000, you have to be ready to lose another 100,000. She said, no, I'm not ready to lose. I want to make back that 100,000 that I lose. Then I tell her, the stock market doesn't work that way. Every time you place a trade, you have a chance to lose, and you need to be ready to lose in order to win. So those people who can win in the financial market, in reality, they don't really need the money. That's why they can win. That's why they can trade with a very calm heart. Those who are desperate for money, they cannot afford to lose. They can't win because they have too much stress placed on them, right? Just beware of what I said. Just think about it, okay? So if you can't afford to trade, don't trade. Accumulate the money, and until you have enough money that I will call that the money you can afford to burn. Like I started trading when I have about 100,000 that I can afford to burn, and it doesn't affect my life. That's where I started trading. All right. If you don't have that 100,000 that you can afford to burn and you don't feel pain, you can't trade. Just don't trade. All right. Just don't trade. All right. So that's my advice for you. So there are some patterns called sharp, and it's the same thing. Either cipher, sharp, bad. It doesn't matter. It's just how it's a counter trend signal. So beware again, it's a counter trend signal, right? So again, an example, here alone, it's not convincing. Multi-dimensional is more convincing. You have a VSA red, you have price reaching the upper Bollinger Band, and then you have a harmonic short pattern. All three are telling you that it is short. Okay, so don't long. Take heed of the technical indicators that you trust. But if you don't trust the technical indicator, you can't really use them, right? You have to trust them 100% in order to utilize them. Because why? You're going to lose. Even though you follow every signal, 40% of the time, okay, you only have 60% winning trade, because this is the odds of these indicators. They have their limitation because these are quite old indicators. So it have limited. It's only about 60% winning trade. But we talk about, oh, every 10 trades I can win 6 sounds good. But every 100 trades, I may lose 40 trades first. That doesn't sound good at all. You say, oh, I can't afford to lose 40 trades. But who knows? The 40 losing trades can come first. Then the 60 losing trade is at the back. And then if you give up, you will never see the other 6 winning trades, right? Correct? That's how things work. So if you want to talk about technical trading, you're talking about probability, statistics, you're talking about science, you're talking about something like casino odds, you're talking about basically statistics. And statistics, you have to accept failure. You have to accept that you follow every single signal correctly, okay, and you might still lose because it's just one of those 40 trades that you are destined to lose, even though you follow every signal correctly. And that is the part where trading is difficult. So before I go to economic data release, I just want to, summarize it, that why is trading difficult psychologically? Because if you follow every single signal correctly and steps correctly, and this is assuming like the USA market is like, during our sleeping hours, you need to stay up until 3, 4 in the morning every day. This is what I did. During my career, I stay up until 4 o'clock in the morning every day for the last 15 years. Yeah, it is not a human life. It is a very difficult life to live. Your spouse or your family, whoever, has to be very understanding. And it can come anytime, and you get everything right, and you will still get 40 losing trades out of every 100 trades. And that is trading. And that is very difficult to swallow. It's like, wow, shit, I got everything right and I still lose. And the next trade, I follow everything and I still lose. And the next trade, I follow everything. You say, this is bullshit. I'm going to give up. It's just 3 trades. 3 trades doesn't mean anything. You need to go through 100 trades. And that is mental torture. Again and again and again. And you need to be tortured 100 times. Finally, you see the light at the end of the tunnel. Hey, actually 100 trades, I actually win 60. The strategy works, yeah. After you're being tortured in every trade of potential losing and the fear of losing, every trade is a mental agony. All right, so that is trading. So let's go to the 4th dimension, which is the market bias analysis coming from economic data release. Economic data release, it is not really a good news or a bad news. So let me just put it in a very layman term. Yeah, it's not about good news or bad news, really. It's really about the expectation of good news and the expectation of bad news. Okay? If everyone expects this to be a very good news and the bad news come out, this is going to happen. This is going to happen. Right. And this is what we are waiting for. We want this to happen. Why? So what are we waiting for again? Let's summarize. First, red color, overbought. Signs are coming down. Reaching Bollinger Band +3, coming down. Harmonic pattern, okay, of short. Red color is short, blue color is long, right? So it's short. So all 3 technical telling you that it is bad. And what is the last thing we are waiting for? The expectation of a good news. That's why price goes up. Because everyone is expecting a good news or a neutral news or not such a bad news. So what are we waiting for? A bad news. So when the bad news comes out, it caught everybody as a surprise and price crashes. So you have to be fast to react to this. And the answer to you is no. Human, we are not fast enough. HFT will always be much faster than us by 1,000 times. So please automate it. That before you can win. If you manually trade, you have to be really fast. Your eyes and coordination, hand coordination, have to be really fast to win this game. All right. So the best is automate the thing. So 4 dimensions of a winning strategy: volatility dimension, price dimension, volume dimension, and the last is the contrarian of the expectation versus outcome. People expect the news to be bad, and the news is good. Price will shoot up. People expect the news to be good, and the price is bad, and the news is bad. Price will crash down. That's what we want to see. That is how we can make money from this discrepancy in expectation versus outcome. If people expect the price to be good and the price is good and the news is good, market will not move much. People expect the news is bad and the news is actually bad. You can't make money out of it. So the key component of making money is expectation of the market versus reality. So what must you know? You must know what the market expects. That is the hard part of trading. You have to know the consensus of the analysts, of the retail market, of the institutional market. Then you have to know what actually happened, and then you need to act fast enough in order to catch this move. Okay, right? Very, 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 very bad sentiment. People think it's going to be bad news. Okay, but everything is telling you, the harmonic, the VSA, and the Malaysia are telling you price is going to reverse, and all you need is one small good news or not such a bad news, price will jump up. So the key takeaway of today is, whenever everyone expects the news to be bad, only look for opportunity to long, not short. Everyone expects the news to be good, only look for opportunity to short and not long. This works very, very well with Forex futures and with futures, with the index futures and with commodity futures. Okay, it works very well. So remember this key component to it. All right. So I have many examples here in the slide. I think you can definitely download the slides. If you can request Excel learn for the slide, they can give the slide to you. I don't really mind, definitely. You know, I'm done with this game. It was a very fun game. I had my fun, and it's your error now. If you want to play with it, you know, it is your error. So this is FKLI, I believe. Yeah, there we go. FKLI. The harmonic works as well. You know, it's double retracement. You know, and then it's a short point, and it's a cipher pattern, and it comes down. And then you can use harmonic for the stop loss and the profit as well. Okay, so it works on FKLI, KLCI. Right, and another example. There are many examples I put here. So I don't have time to go through it, right? Just given like 45 minutes. So please go through it themselves and ask for the slides. You can have all my slides. I don't really mind. You know. Yeah, I'm glad. You know, these are all the patterns. You have the butterfly, cipher, shark, and this and that. A lot of patterns, right? So please, main takeaway of today is multi-dimensional analysis. It has to be one fundamental, which I use economic data review, and it has to be contrarian of expectation versus reality. So that's one dimension. And then you have the volatility dimension, and then you have the price dimension, and then you have the volume dimension. 4 dimensions. That forms the basic foundation of a strategy. One strategy trading one product. You need to know all this in order to win. So you can see who teach me? No, nobody teach me. It's everything self-taught. So you can see how serious I was in my young days. Right. Every day, 24 hours, I just analyze how to win. It's just like now golf. 24 hours and like how to win in golf. You know, how to improve, how to win. 24 hours, just sleep it, eat it, dream it, and just think of trading. And just focus on one product. FCPO or FKY. One product. Start with one. And just try to win with one. All right. Lots and lots of example on that. So there we go. I have one example here. Of course, I don't have time to play robot, but all these are free as well. Automated harmonic robots. Okay, you can just play. You can just use the robot to automate trading for you. You know, or there are a lot of all these robots are online for free. You can do and search for them. Okay. So again, more examples here. Right, a lot of it. These are all very old notes, okay, but they share one thing in common, is that it's multi-dimensional, different examples, different asset classes, same approach, same concept, same conceptual framework. You can use this conceptual framework in all other products, except options, because options, nowadays I can see a lot of seminar advertisement on YouTube, you know, all this. Please be advised, option is a very difficult game to win. It's a sucker's game. And nobody wins in option. Those that as far as I know. I have a friend who won about 5 million in option and to be given all back in just 1 or 2 losing trades. So please don't play options. Other than that, this strategy that I share tonight applies to all other asset class, including FX, includes futures, includes stocks. and all the things. So there you go. This is what I was talking about. This is below here is another indicator on fund flow, right? That the gray color is the institution, the red color is the retail, and the pink color is the syndicate. So who is manipulating the market? And who is actually the retail, and the overall volume is the black. So this is what we call fund flow indicators. So this is very important. So combine harmonic with fund flow instead of VSA is an upgrade, is an improvement. So you can keep on improving by modular basis. You can just change the module. You don't have to change the overall strategy. So if you want to program a system, object-oriented is the way to go. Okay, it is the way to go. So let me just go to the last part, how to automate. I have a lot of examples how people can win using this approach, right? A lot of good examples. So how to automate is for futures. Okay, for futures, you need to automate, and for stocks as well, you can automate in this way. Means that you connect to your local broker, and then they have the API vendor. You need to connect to them. Like end-to-end is Afin's vendor. You want to connect to RHB, you can use QST, quick screen trading, which is the one that we use. So you have the mastermind, which is your Python or your big data analysis processor to have the strategy. Then the strategy gives the signal, and the signal can actually execute in the local broker, RHB or CIMB using Fedesa, and Afin is using FIS, or they are using end-to-end. And then trading technology is used by GF Apex and many others. Okay, public banks using Excel Force and many others. So you need to be connected to their local API vendor. And quick screen trading is the one that if you are using RHB, you can automate your FCPO trading, FTOI trading through the RHB. So what you have is that your strategy must be in your computer, and your computer can connect to RHB's vendor, which is QST, and they give you an app. So you just follow through the process, connect to them, and then your account can be shown here, and then you will see the connection button. Once it's connected, right, you have to get all the configuration correct. When it's connected, then you are able to be automated. Full automation of FTOI, FCPO trading, all right, through using the local vendors, their API vendor. Okay, so probably, yeah, just share until today. Share until here, probably about 9:45. All right, so I'll just, I think, open up to Q&A session. All right, CY. All right, I'll just go back to you then. All right.